Right, we're at 5 after, so we're going to go ahead and get started. I can see some people are still coming in, so thank you everyone for signing on, and welcome to this webinar, How to Raise Your Series A with Visible. Very happy to have you here. Visible's mission is to help startups succeed, and so hopefully with this webinar we can help you be successful when it comes time to raise your Series A. I'd like to go ahead and introduce myself. My name is Andrew Clark. I am the CGO at Visible. I've spent about the last decade or so helping startups launch and scale. And I have participated in several fundraising rounds and also a couple of exits. So I definitely know the stresses and questions that come with it. And now here at Visible, I help startups leverage their investors, grow their companies through our platform. I'm joined today by Eric Christopher. He's the CEO and co-founder of Zylo, and I'll let Eric introduce himself real quick here.
Hi, thanks. Glad to be here. I guess over the last, I guess it's been about a year and a half ago, I just went through raising a Series A, so I'm happy to share my story. As mentioned, I'm the co-founder and CEO of Zylo, and we're an enterprise platform that helps companies manage their software subscriptions. So glad to be here.
Cool. Thank you, Eric. Also want to introduce one more important person. That's Matt Pruce. He is standing by. He does marketing ops and customer success here at Visible. If you're a Visible customer here on the webinar today, you probably already know Matt. But in addition to those things, he kind of helps out with a little bit of everything. So he is standing by to make sure we go off without a hitch today. Taking questions in the chat. You can also do questions on Twitter using hashtag Visible Webinars, or send him an email, matt@visible.vc. So let's go over what we're going to cover today. It's a little bit of a different format for a webinar. So we are going to start with kind of a formal presentation. I've got some slides to go through. And from there, we're going to move on to kind of a discussion with Eric about his experience raising Series A. Then we want to leave plenty of time for Q&A as well. And so in the presentation part, we're going to first say, how do you determine if you're ready to raise your Series A? And then from there, what is the prep work that you need to do if you are ready in order to start? And then we're going to talk a little bit about follow-on funding and how follow-on funding can have an impact on your raise and what it can do when you start fundraising. And then we'll talk about how to handle investor outreach. And finally, we'll move on to that discussion and Q&A portion. So kind of a lot to cover today, and we want to make sure that we get to everything. So let's go ahead and get started. The first question that we want to tackle is, how do you know if you're ready to raise a Series A? I think it's a really common question for companies that are kind of right on the edge. And so what are the benchmarks that you look for in order to determine that? Before we dive into that, I do want to do a quick poll. We are doing a little bit of audience participation. Make sure you're all awake. This poll question is just, when are you planning to raise your Series A? So you should see that here in the chat. If you want to go ahead and start answering that, I'd just like to get a good feel for, as I expected, we've got a pretty good mix here. Everything from I've already started to not currently planning on it, kind of a really solid mix. But a lot of you, I think, the majority of you are planning on raising within the year, which is about what I expected. And we can definitely help you get prepared for that. So thanks a lot for submitting those answers in the poll. So how to determine if you're ready for a Series A? The biggest thing to keep in mind here is it really depends on a number of different factors. And those factors range from the industry you're in, to your business model, to the audience and your team size and how much runway you have. There are cases where if you need more money, you need more money, and that's when it's time to raise your Series A. But what we're talking about is how do you determine the optimal time to raise, and how do you figure out what will give you the highest chance of success? And for that, I've broken it down into 3 elements to keep in mind. One is, have you built an engine? The second is, are your metrics healthy? And the third one is, can you tell a compelling story? And if you have all 3 of those, then it's very likely that you're ready to raise your Series A. And I want to get into what each of those means here now. So the first one is the engine. And what that means is, have you built an engine for acquisition? Now, acquisition of what is going to depend on your company. It may be customers, could be revenue or users. It really depends. But the biggest thing is, have you built something that is predictable, scalable, and demonstrates product marketing fit? So the first one is it predictable? Which means, do you have a good idea of what your spend and your efforts are going to deliver? So if you put $1 in, do you get $1 out? A certain degree of predictability is just a huge factor for investors to look at, because the more predictable it is, the less risk there is for them. The second one is it scalable? If you had more resources, if you could put more resources through that same engine, would you anticipate a similar return? If you've built an engine that's scalable, that putting more money behind it is going to yield more results, then that's obviously very attractive to investors. The third one is product market fit, and that's a little bit harder to define. What you're looking for with product market fit is the company's growing, customers are sticking around, and customers love your product and they refer others to your product. So growing is pretty straightforward. Obviously, if your company's growing, then there's a good chance that you've achieved product marketing fit. But then the other element of that is, how are customers reacting to it? And I think we'll talk about this a little bit later as well. But if you can get good at selling, but if you have customers leaving just as regularly, then there's probably time to look and see how you can work toward a better product market fit. Point to signs that your product is clicking with your target customer. If you can find those and identify those, then it's very likely that you've achieved that product marketing fit that you're looking for. So those are the 3 things that I think really make up the engine. It's predictability, scalability, and signs of product market fit. This is not a thing that's going to feel like we did it. You wake up one day and you suddenly have built an engine and it feels great. But there are going to be signals that you can look at for each of these 3 items, predictability, scalability, and product market fit, that indicate that you're well on your way. The next thing is metrics, probably the most straightforward of them. That with metrics, you're going to look at, do you have accelerating growth? Do you have low churn? Do you have efficient acquisition? And some of that gets wrapped up into that product marketing fit discussion as well. The thing about Series A that's different than seed is, seed rounds are often raised on intangibles. Is the idea good? Is the team strong? Is there a good plan for the future? So seed often gets raised on kind of vision. Series A is much more focused on traction. And because of that, your metrics need to be really healthy. I've got a great resource from Better Every Day that has actual numbers for different spaces. Matt's going to throw that in the chat if you want to look and see kind of a number, a very specific kind of prescriptive look at what you need to be showing to raise a Series A round, depending on the space that you're in. In general, though, it's these 3 items, right? Accelerating growth, low churn, efficient acquisition. So growing at an accelerated rate, usually slow and steady growth is not going to cut it. What you need to demonstrate is a ramp up, a kind of a snowball effect of growth. The second one is low churn. So, like I said before, sometimes startups get so good at selling that they don't realize until it's too late that the product doesn't really live up to the sale. And so you need to be able to acquire new customers, but you also need to be able to keep people around. If you're in a situation where you're selling really well but also have high churn, that's something that will need to be figured out before a Series A raise is optimal. That's something that will definitely come up in investor conversations if that's happening. The third one is acquiring efficiently. So this is similar to the engine, but are the margins that you're acquiring customers or revenue at sustainable? Months to payback, for instance, is a big metric for SaaS. There are similar metrics for other business models, but the idea is, can we get new customers? Can we get new revenue in the door without spending an inordinate amount of money? If these three high-level metrics are healthy, then you're probably in good shape on the metric side. Certainly, you want to dig in a little bit deeper, pay attention to some more granular metrics, but these are the big three that are going to indicate readiness for a Series A. And the third one is the story. Can you tell a compelling story about your business? Every investor wants to hear a good story, and this story is specifically about what have you done so far, and what are you prepared to do, and what are you capable of if you have the right resources. And then the last one is who cares? Why does it matter? And that may be the most important part. If you can confidently go to your investors and say, in the beginning, we set out to do X, and we did X. With more money, we could do Y, and we could do Z. Well, that provides a really great reason for them to give you more money, because if they like the sound of Y and Z, and they believe that you can do it, then they'll be compelled to invest because they like that story and they think that you're capable of making it happen. I say that and it sounds super easy. It's probably the hardest of the three is to come up with this compelling story. Another great resource that we're going to put in the chat is from the Atrium blog. It goes into pretty good depth on how to tell a compelling story when you're fundraising. And I would definitely recommend checking it out. But I think those three elements are the three things you've got to keep in mind when you're raising a Series A. What have you done? What can you do? And why does it matter? What will be the impact? So just in quick review, if you've built an engine for acquisition, if your metrics are healthy, and you can tell a compelling story, you are probably ready to raise your Series A. So now that we've talked about that, we want to talk about how to prepare for your Series A once you're ready. I am seeing questions coming in, but as a reminder, you can submit those via the chat or on Twitter with that hashtag #VisibleWebinars. So let's talk about three most important things when figuring out how to prepare for your Series A. Number one is preparing yourself. Number two is preparing the company. Number three is preparing the pitch. And just like before, we're going to talk about each of these in a little bit more detail. So preparing yourself, the first thing that you need to do when preparing yourself is make the commitment. Are you ready to take the plunge into this process? A lot of founders underestimate the amount of time and the amount of effort that it takes to raise a Series A. 5.5 months is the average time. Now that's an average. Not everybody takes 5.5 months, but it's a big undertaking, and probably one of the biggest and most important undertakings that you can make as a CEO, especially if you're raising a Series A for the first time. I've got a resource from Real Ventures that we're going to share in the chat as well. It's a multi-part series on preparing for a Series A, but it's telling that what it begins with is preparing yourself. It takes a long time. You have to make sure that you're personally committed. You also have to ask yourself if you're confident. Do you believe in your business? Do you believe in the story that you're telling? Because if it is fake, if it is disingenuous, your investors are not going to buy it. And if you don't believe in the story that you're telling, investors will know that. So if you run into a situation where you don't believe in what the story that you're telling, figure out why and fix that situation before you start to raise, because you don't want to be in front of investors and appear like somebody who doesn't believe in the business that they're running. The third piece of advice here would be to know your ask. So you need to know why you're excited about your company's story and why you're excited about the future. So you also just need to know what you want in very plain terms. How much money do you want to raise? Do you want to have a lead investor? Are there certain expectations that you have for your investors? Investors are more than just a source of capital. And so what else do you want in an investor partner? Is it a situation where you want somebody who will be very involved in the business and give advice? Is it something that you're looking for people with a good network in the industry you're trying to reach? Make sure you know what that looks like and what you're asking for, so that when you come to the table, you know what you want. The whole process gets easier when you have a filter of, does this line up with what I set out to get or not? Just share a Jason Lemkin quote here. Basically, the CEO has to be the point person on raises. Co-pitching is fine, but everything that we've heard, everything that we've seen says, if you don't have your CEO out there trying to make the raise happen, then you're putting yourself at a huge disadvantage when it comes to raising a Series A. So after you've prepared yourself, you're going to want to look at preparing your company. And so assuming things go well, investors are going to want to do due diligence. And a good piece of advice is, don't wait until the investors start asking to prepare for that. You can start doing preparations for due diligence well in advance. You can get your metrics in order. The worst thing that can happen when an investor is ready to invest in you is they get surprised by new negative information. So the earlier that you start this process, the earlier you start getting your metrics and your tech in order, the easier, the less likely it is that you'll run into any surprises, and the easier your raise is going to be. The second one is have the right people in place. So if you are about to undertake a Series A raise, you're about to spend a lot less time in the day-to-day of your business. And so you need to make sure that things are in order. I recently wrote a post for the Powder Keg blog that goes into this topic really in depth. And so Matt will put that link in the chat. It's fairly prescriptive on some steps you can take in order to get your team ready. But high level, you want to have a point person that is kind of the go-to, that fill in the role of the decision maker and the go-to when you are away from the business. You also want to set your team up for success while you're focused on fundraising. The final thing is, you want to make sure that you've built enthusiasm around the raise. So there are a couple of reasons for that. But really, you want the whole team behind you. First of all, because some startup employees can get antsy about outside money and what is going to change when this raise happens. And so you want to make sure that everybody in the company is bought in on the vision and what you're trying to do. Second of all, we've already talked about it. You're about to be away from the office a lot more. You're going to be a lot less involved in the day-to-day. And so if all your team members and all your employees see is a CEO who isn't involved as much, they may start to lose some enthusiasm. They may have a whole lot of questions about what's going on. And so the alternative is getting them bought in, getting them excited. Then not only will they be at a place that they need to be, but they will also help encourage you. So when you start to raise and you hit kind of a wall, or some no's start coming in, you've got a whole team behind you encouraging you. So with that, I highly suggest being as transparent as possible, as transparent as you are comfortable being, because it's going to make a big difference in just overall vibe of the team, but it can also help encourage you as you do this process. The final thing you need to prepare is the pitch. What this looks like varies greatly from company to company, but it comes down to telling a story. So it's problem and solution. What's the problem and how are you solving it? Momentum, what are the results so far? And opportunity, what happens if this works? So problem solution comes to that compelling story that we talked about. Momentum is metrics, but it's more than metrics too. I think it's anecdotal. It's enthusiasm from your customers. It's social proof. If you've signed a known logo, or you have people, tweeting about you or something like that, all that matters, because what you want to demonstrate is not only are you hitting all the metrics that you want to hit, but people are excited about the solution that you're providing. Finally, it's opportunity. So you want to paint a clear picture of the future. What happens if you succeed? Because if you can create a clear picture of the future and then make investors want to be a part of that future, then you have a lot of leverage there. You can create a little FOMO. You can get them really excited about that future and make them want to be a part of it. Just a few extra tips here for preparing your pitch. Super important to know your numbers inside and out. If investors that you're talking to ask you for some of your high-level metrics, you don't want to be checking your systems. You don't want to get back with them or look at reference slides. You just want to know it. And so knowing the numbers inside and out is huge when you're actually in the pitch. You also want to think beforehand about how you'll handle objections. So you can probably make a list of the likely objections that you're going to get before you do this raise. And so figure them out, figure out how to get in front of them. Don't try to hide anything or bury information, because if you have a weakness, investors know how to figure that out. And so just address it up front, and also address how you're going to fix it. And then the final piece of advice on the pitch, and I think it's really important, is you need to know what gets you excited. What is your real motivation for doing the work that you're doing, and what is your real motivation for the company? And then take that item or the thing that gets you the most excited and save that for toward the end of your speech. A lot of the times I've seen pitch decks that end on like the boring stuff. They start really exciting, they end on the boring stuff, and then they ask for questions. And what you want to end with is something that you're incredibly excited about, so that your excitement can become the excitement of the investors as well. It has to be genuine. You can't fake it. So if what you're excited about is making a ton of money, talk about that. If what you're excited about is changing the world, talk about that. You just want to make sure that toward the end of your pitch, you're talking about something that's real to you, that's motivating to you, so that you are ending on a good note. Next, I want to talk about follow-on funding for your raise. And what I mean by follow-on funding is getting money from your existing investors. So we have a quote from Jason Calacanis here. We have a rule on this webinar that you can only use quotes from people named Jason. So these are the two we went with. But it speaks to how important your current investors can be if you're treating them right along the way. And so let's talk about why follow-on money matters. Anytime you're pitching, it helps when you already have money committed. So if you can go to an investor and say, we're already this far into our round, then that's great. If it's from a current investor, if it's from somebody who's invested in you before, it's a really good signal to the other investors that you might be talking to, because it's almost like your previous investors vouching for you. Your previous investors have trusted you once, And so if they decide to reinvest, it's likely that you didn't let them down, and they're willing to trust you again with more money. And so what that means to other investors is that you're a good company to work with. The other thing is warm introductions. So investors know other investors, and whether your current investors decide to follow on or not, they can also give warm introductions to other people who might be interested. So get those warm introductions from your investors. And with all of this, previous communication with your investors is key. You can't just go to them when you need something. You want to make sure that you're communicating, you're sending your investor updates, and you are keeping them involved in the business before you raise money from them. Just an interesting note, but Visible Customers raised $600 million in follow-on funding in 2018. And that is thanks in part to just very good, consistent investor communication. So that's why it matters. And I do want to real quickly talk about why I believe that you should pitch existing investors. This is almost like a tangent, but I just want to press on it a little bit. I think that you should formally pitch all of the existing investors that you have that you want to continue to work with, or you'd like to get follow-on funding for. If you're starting a new round, those are the people you should start with. Pitch the people from your previous round. And this is a real pitch. This is not, let's do a coffee or a lunch and talk about what you're thinking of raising. This is, can I sit in your boardroom or your meeting room and pitch you just like I'm going to pitch everyone else? And there's a couple reasons for that. The first is fairly obvious. They're investors. They know what other investors are going to look for. And so they can be a really good source of feedback for you. The second thing is it keeps you honest. So your current investors know your flaws. Hopefully they've been somewhat involved in your business. And if you pitch them your formal pitch that you're going to take to others, it's going to make sure that you aren't including anything that might be a little questionable, or kind of shine over some areas of your business that may need a little bit of improvement. They will call you out on those things, and that can be extremely valuable, because you don't want a stranger that you're not familiar with calling you out on them. The third thing is it also gives your current investors a fresh look at your business. So there is just a bit of shiny object factor that companies, basically if your company is not absolutely on fire or absolutely tanking, it can be easy to get overlooked by your investors. And so you want them to see your business as these new investors will. Kind of take the previous baggage or context out of it, see your business with new eyes, so that they can really get excited about you again. Obviously, the more you practice your pitch, the better you'll be, and current investors are a pretty low risk place to start with pitches. So once you're prepared, you're ready to pitch, you've talked to your current investors and have maybe secured some follow-on funding, then you want to start doing outreach. And that's the next thing we're going to talk about is investor outreach. So first, you want to make a list. I think this starts with a spreadsheet. You list investors, and then I would say do some research and actually score them, rank them, figure out who can I get an introduction to, who would I really love to work with, and then prioritize the investors in the order that you would like to. If all of them gave you offers, this is the order you would accept it in. I would say also don't get skimpy with your investor list. More options is always better. There are definitely diminishing returns on that, but I would say you want a list of 15 to 20 possible investors, and start there. I've talked to plenty of founders who have talked to 30, 40, 50, 60 investors during their Series A raise. Not all of them necessarily pitched, but conversations have happened. And so I would say at least start with that 15 to 20 person list, and then you can narrow it down after that. Once you have your list, you want to start reaching out and booking meetings. Cold outreach is totally fine, but if you can get an intro, any intro that you can get will make such a big difference. It will make things so much better. So get any kind of warm intro first whenever possible. Second, if you are doing cold outreach, just make sure that very straightforward email that is well written and says exactly what you're asking for. It's very clear. I recommend that you batch these meetings up. I've seen that recommendation in a couple other places as well. You want to try to keep most investors at around the same stage during the fundraising process, especially up front. You're never going to get it to align perfectly, but there are definitely some disadvantages to having one or two investors who are just about ready to sign a term sheet and 5 other investors that haven't even scheduled a meeting yet. So you want to keep everybody around the same stage in the process, so you don't put yourself at a disadvantage. If you aren't very involved in the sales side of your business, this is a good time to brush up on the sales skills. You got to do it. Pitch-in is selling yourself. Pitch-in is selling the company. And so at the Series A level, it's also a really big sale. And so you want to brush up on those sales skills. If it makes sense for your company, spend some time with your sales leader or with the sales team. Go to a couple of their meetings or trainings and actually spend time with them to kind of refresh yourself on some of those sales processes. You'll also pick up on some of their energy. You spend enough time with sales teams, it's hard to not get some of that contagious energy, and it can be very helpful in the pitch process. Alongside that, I think it should go without saying, but communication with potential investors should be excellent. You should have perfect follow through. You should always do what you say you're going to do, exactly when you say you're going to do it. Be proactive with communication. Outside of the pitch itself and the metrics that go with it, this communication is like one of the few data points that investors will use to make a decision on you. So don't take it for granted that the communication needs to be really strong. For that reason, I highly, highly recommend tracking your fundraise somewhere. Have a system, keep it up to date. Just be like a good salesperson that keeps the CRM up to date all the time. You want to make sure that you have that you're very diligent on that. Visible actually built a fundraise tracking tool. It's free to use. It's basically a fancy Google sheet. But if you do need a place to track your raise, it's not a bad place to start. We can put that in the chat so that you can download it if you like. But it's essentially a light CRM and a Google sheet, and it'll help you track your raise, figure out how much you have committed, and keep track of all these different interactions that you're having. All right, so we have so far covered how to know if you're ready for your Series A, how you can prep, the role of follow-on funding in the raise, how to do investor outreach. And so the next thing that we're going to do is shift to our guest, Eric Christopher, to talk through about his experience. Right before I do that, I want to give you 3 things that you can get started on right away. I always like tangible takeaways for webinars, so I'm going to give you 3. Regardless of how soon you're going to do your raise, all 3 of these things will help. Number 1 is get serious about your metrics. Metrics are the key to raising money in a Series A. The longer you wait, the harder they're going to be to figure out. So even if you're very early on, get serious about your metrics and make sure you're keeping track of them. Second is develop those communication rhythms. If you aren't doing updates for your current investors, if you aren't continually keeping them in the loop, now's perfect time to start. You want to make sure that all your investors are tuned into your business, and when it's time to ask them for money, that's going to help that a lot. Along with that, if you do have investors that have kind of expressed an interest in your business, said they might be interested in investing later on, send them updates too. The update can be different, it can be lighter, but send them some updates so that you stay top of mind for them, so that when you come call in, they don't need a huge refresher. They already have kind of been watching you, and can make an easier determination that way. It's basically like a drip campaign for your fundraise. Finally, this one's a little biased, but I would suggest signing up for the Founders Forward. It's visible as weekly email. Every week we just pull a bunch of the best startup content from around the web, put it in one nice digest for you, and we also have our own content on there as well. You can sign up for the Founders Forward. Link is in the chat. All right, let's turn now to Eric Christopher, who's our guest today. We're going to have a quick conversation about what he learned from his Series A, and then we are going to devote the rest of the time to that and to Q&A. Eric, why don't we start with just a little bit of context if you want to tell us just a little bit about you and about Zylo.
Yeah, thanks. Yeah, great presentation, and excited to share some thoughts, with you about fundraising. It's like fun and a fun process, or it can be. So my background, I'm currently co-founder and CEO of Zylo. We're a company that's actually, I guess you'd say we're going to be, we're past our Series A, and our next phase would be Series B. So kind of fresh off of a recent experience that hopefully will be useful. Just real quick is that I've been in the SaaS industry for about 16 years. I started right out of college with my own startup, failed quickly, led me to being an early employee at ExactTarget, where I spent a career in sales there, going from just a small number of employees all the way to nearly 1,000 when I left. So it was a really great learning experience about being part of a venture-backed company at various stages. I've led sales teams at other SaaS companies as a follow-on to that. And then I, went back to my roots and tried to start a company again, which I did, which is now Zylo. So here we are.
Awesome. Thank you. And what did your Series A process look like? Do you want to just give sort of the broad overview of that?
Yeah. And I think a lot of the things that you talked about kind of as a framework were certainly things that we followed about, feeling like we had confidence about some of our metrics, seeing, feedback from customers and things like that. But I'll kind of walk through our thought. We raised a seed round. And we decided that, we'd use a rule of thumb that we would want to be in a place where we could raise capital with six months of cash runway at a minimum. So that way we didn't feel we were waiting too long, and it could give us enough time, to run a process. As you mentioned, this could be a 5-month or longer process. So if you want to make sure you leave yourself some time. So we kind of use that as like, okay, at a kind of a worst case scenario, right? Or just kind of thinking of a plan B, we need to be in a place where we could raise at that point. And then we really looked in more outward and said, okay, what do we need to be true to be the best Series A that we could get, right? And so we kind of set out what those things would be, which was right. This is right after the seed round, and then we worked a lot of our goal setting and some of our milestones and things that we set to kind of fit, into that timeline. And those were, revenue, team, the people we wanted to hire, the people we planned to hire, those sorts of things. And then that's what led us up to choosing when to go, raise our Series A. So that's kind of the lead up plan. So maybe we could start there.
Yeah.
From the actual process itself, maybe we could go a couple different directions. I'll just kind of say, like, so we can come back, to some of the things we did, if we want to dig more into the things I just mentioned. But when we thought about the process, we looked at, we took a lot of the advice you just gave. We have great relationships and existing investors that gave us an early bet in our business. And while we were going towards those milestones and hitting those types of metrics, I would make sure that I would go back to our existing investors, give those updates regularly, ask for referrals to other investors that are more in the Series A and Series B kind of, where that's their focus. And I began to start developing those relationships. And so that kind of referral network, showing progress, hitting our milestones was what allowed us to kind of build that list of target investors. And then ultimately, when we started getting close to those metrics and kind of that time period, We decided to kind of stack rank investors based on fit, based on location, a variety of factors. And one thing I'll emphasize is, we probably targeted about 60 investors. And I think a lot of founders underestimate the amount of no's that you're going to get, which is, by the way, healthy and part of the process. And we decided to, kind of plan our kind of attack of calling down those investors. And some of them were cold, some of them were warm, kind of all of the above. And we kind of ran a process that probably ended up being about 2 months in total.
Gotcha. And supposedly that's pretty fast, considering the average is 5.5. So good for you. When you were talking to investors, what seemed like the most important things, or what were the things that they really latched onto? I know that there are certainly specific things about Zylo, but in general, would you say it was more very metric driven? Was it more about the story, the team? Like, what did that look like?
Yeah, great question. I was going to add, I think to some of the content that you presented. I think the one thing we're all competing against now, it's like a new kind of world where SaaS metrics are much more kind of publicly available, and investors are able to, kind of stack rank all of us based on efficiency metrics and things like that. So obviously those are the core things like that. That's sort of an important thing you're going to get to, and you need to back up the story you're telling with good metrics. But I think the thing that really resonates for even Series A, and certainly at a seed level as well, but you need to show, number one, that there's a big market opportunity. I think if you can show that while you've got, the assumption of some good metrics, or, above average sort of thing, right? That is one thing an investor wants to just see, is like, how big can this business really be? And some investors think really massive markets. Some are, okay with smaller markets and things like that. But you really have to show there's an exciting market to win. And then you need to show that you're winning. Not that you're winning the whole market, that you own it. Everybody knows Series A is very early, but you need to show that you're winning it. That could be great customer stories. It could be that you've got exceptional high contract values for your stage, or it could mean that you've got a high demand of usage. You got a freemium play where the monetization is going to happen later, but you're just getting an amazing amount of high usage, but you're showing that you're winning the market. And the third piece is your team. The people in your business and the story are as important as the story and the market and the metrics. They are ultimately investing in you at this stage. And many times if you're a single founder, you need to really show that you've got other people that are really strong, that are as passionate as you, that augment you and that sort of thing. But the team, was a big deal. So for me, we had a really good story at the time. Our story was very experienced team and a great set of early investors that bet on our idea. We showed that within a year of that early investment, that we could begin proving out that our thesis of what we're doing is true. It's like what we thought would happen is beginning to happen. We had some great early customer wins and some sales traction that was impressive, and then we had a product that was working with customers well, and those customers would be references. And then, in our nature of our business, there's a large total addressable market that's out there for this. And so, they start to say, wow, this could be the company, that great team, they're winning early, and it's a huge market. We want to bet on one company that could go, take it all. And so that helped us, I think, a lot, relative to, maybe looking at, other rounds or things like that I've seen in comparison, where maybe they had one or two of those things missing. Great metrics, but team seems not experienced, or those sorts of things. So you kind of have to have a well-rounded story, or if it's not well-rounded, one of those things has to be just so exceptional.
Yeah. When you said that, you were putting together a list of potential investors to reach out to. How much of that was cold outreach? How much of it was introductions? Did you have any success doing cold outreach? I've heard different things from different founders.
Yeah, I mean, cold outreach is really, a lot of the same, kind of it ends up, I think, in a lot of ways, being like in like a sales process where it's a little bit of, you're going to get a mixed bag. You probably have to do a lot more of the outreach just to get in front of the right, people. The challenge with cold outreach is it's hard. You got to identify not only the firm but also the partner and the team that specializes in your in your product. Like we get attracted to investors that really get the cloud enterprise SaaS market. So it wouldn't be great if I was reaching out to a firm that and someone that might be in doing something around new better battery technology or something like that. So for us, I think you have to do a little bit of it all. And I think depending on how strong your existing network is, I think you just got to do what you have most readily available to you. For us, we did some cold outreach because there were some investors that we feel are so strategic to what we're doing. We had to share our story and at least have them give us a look, even if just to give us a market signal as if we're going the right direction. My preference was just like how I've felt sales actually is more effective is going through referrals. So if it's going to be cold, could you maybe work a little bit more advanced and meeting an investor? And some of the things you mentioned earlier about an investor has to get up to speed with your business, and it's really hard to do that over a couple of pitches to get enough confidence to really write to lead around. It's easier for someone maybe to follow on or something if they've only seen a pitch and they see another investor, but to truly to lead around, they really need to be up to speed with your business. So I feel like referrals help build trust, so you can maybe move a little faster if you haven't had a lot of time with them. And ours, I'd say the secret to our Series A was really it's those kind of that story that I was telling you earlier about the three things. But we had existing investors that could validate that had great networks early, and they helped kind of build out that list. So I bet more than half of that list of investors came from me, reaching out to our cap table and saying, hey, I think we're going to go out to a round later this year. And I didn't wait until we were, raising. I actually did it, sort of while it was hot with the seed round. Everybody's kind of happy and, they're excited as new investment. So it's like one of the best things to do is say, hey, in about a year and a half, we're going to go out again, and it's going to be awesome. And would love for you to be a part of it, because you helped me also look at investors that have followed on, and that sort of thing. So I think one thing that, one recommendation for everybody is, really don't discount your existing investors and actually invest in those relationships. And I know some are better than others, but you do that. And, the ones that will, not everybody is going to be, the most responsive or most helpful all the time. But if you do that across the board, you'll get a handful of great investors that help you, with the referral process.
That's great. That's really good advice. Do you remember if you had any yeses from people that started from a cold outreach?
We had, yes, we had meetings. And I think what was important about that was, you mentioned compressing the time period that you're out raising. One thing that's important is, I think that urgency, it's like anything else. If other investors are meeting with you, they'll likely take that meeting. And that's the honest truth.
Very good. I want to make sure that we get to some audience questions, and I know we ran a little bit longer on the presentation side. I do want to ask one more question of you that I see here, which is what are the biggest differences between raising seed and raising Series A? Because I think a lot of people that are on this call, are very familiar with the seed process, probably have never raised a Series A, many of them. And so what was the big difference for you?
Yeah, I think the biggest difference is the seed round is, and the A round from my recent experience was actually, the rounds actually, the components of what the investor was most interested were much the same, except the A was more weighted to the proof points. So the general excitement of the team, the winning, and the market size was still a dominant reason why I think our lead and led our round. But we had so many proof points that it could justify the confidence that we could live up to the next valuation and live up to the next kind of phase of growth. So I think a lot of it's the same principles, but now you can't, kind of rely on just the idea. And maybe like if you're, early days, sometimes you have to pivot around ideas and your customers give you different feedback and stuff like that. I think some investors have a bigger appetite for early product market fit companies where you're maybe still figuring that out a little bit, but you've got to have figured it out in part at least. And so some investors that we would talk to too weren't great fits because candidly, we had a little work to do to get scalability and repeatability at that point. And so some investors will view a Series A as like you found product market fit, and then all you want is, all the investor would like to do is help extend and fuel sales and marketing and things like that, and maybe just do incremental innovation. Versus some investors are like, hey, you're a Series A, we expect you to have enough proof points for us to write a larger check and commitment, but we understand, you're still kind of figuring out, some of that repeatability. So just context wise, it's really interesting as you talk to investors. I think a great question to ask is, how do you define a Series A company? What are other ones? What were the characteristics? And have those conversations before you raise as you identify your list. Because when you write up that list of what to live up to, I tell you, it's very frustrating to meet with an investor where you think you're defining the Series A company the same, and you show up and they want to see very different things than what you are. And the reality is you are what you are, so, maybe it's okay to get a no from investors that view, you should be later stage, or some view that you should be earlier, and, things like that. So hopefully that helps, but it kind of, I think it's that proof point thing is more important. And then the A for us was that, it was really important to make sure that customers knew we were, kind of an early exciting bet that still had, some work to do before we were just going to be a scaling repeatable company.
Sure. Yeah, I like that a lot. Ask the investor how they define a Series A company. I think that's really solid. I want to get to questions from the participants as well. We've got several in here. The first one is somebody asked, can you share with us an example or two of well-written cold outreach emails? We can get those to you for sure. We have some of those in our resources here at Visible, so we'll share some your way. Next question was about the webinar, and so we are recording it. We will send it out to everyone who signed up or registered here probably early next week to get it processed and everything, but we will be sending that out along with all of the resources that we've referenced here. The next question, kind of along the lines, and Eric, I'm going to put this one to you. Is there a big difference in pitching for a Series B? So you're preparing for a Series B sometime in the future, and if I heard you correctly, you definitely get started earlier than you're actually doing it. So what did that look like? Is there a difference between this coming raise and the one that you've already completed?
Yeah, that's a good question. We haven't raised our Series B, and we haven't started the process. But I feel like following a little bit of the same, guidelines of, kind of writing up what we know needs to be true, and, kind of focusing on the timeline and some of those kind of things, I think are just kind of good sound, ways where I think they're very similar, as far as running the process. And it's the same thing, like, figuring out which, what does someone define as a Series B? It is very common for, companies or venture capital companies, some may view one may view a company as it's really their, they would say they would have been a Series A size company. And then some might say that they do earlier, kind of big opportunity type of bets that feels more like a Series B. So just in general, I think you always have a little bit of, sort of those rounds and kind of perception can be interchanged a little bit depending on the investor. I think now the proof points, the team and kind of the proof has already been there. Other investors have actually made that bet, enough of them that now it's really about, can you strive towards efficiency? Can you show that you can maybe add other lines of revenue, that you can grow customers. Generally now you've got a little bit of history, so it's not about the future. It's a little bit about historically, how are your customers using the product? Is it mission critical or not? Is it, are customers renewing? Now your churn becomes as important as your growth. So those are the things that I think really change the game a little bit, is you now have history that you're measured against, and it's your own history, versus you just kind of comparing yourself of how fast you got out of the gates amongst other companies that started at zero.
Sure.
So that new added dynamic, I think, is a big part of the B.
Great. Next question that I'm seeing, what is the minimum equity in the founder's hands before a VC will even consider looking at a deal? I'll take this real quick, and then Eric would be interested in any thoughts you have as well. But certainly, if a founder has low equity in the company, it does put you at a disadvantage when you're fundraising. But I think the idea that a VC wouldn't even look at a deal is probably a little off. I know plenty of great founders that have raised money with, owning 5 to 10% of the company. And so I don't think it's an absolute deal killer for every VC out there. What's been your experience, Eric?
I do know that there's such a wide range of equity ownership just based on how a company starts and who's backed it in the early days, and and things like that. I think the biggest question there, when an investor starts kind of asking about like what's the ideal amount, the thing that an investor really wants to know, especially at a Series A, I do think at a Series B as well, even at that stage, are you in it for a long time?
Yeah.
They're investing in you. And so the real, where I think the question really is, I think the investor, if they feel like you don't have enough, the conversation should really be, you've got the right type of investor when they're asking you the questions like, do you have enough in this? And sincerely ask that question, because they also may encourage making sure that the founders, retain some of the dilution, or, with additional stock options or things like that. Versus like, when you start kind of thinking about board dynamics and voting rights and all those sorts of things at a Series A, those are kind of the wrong questions. Because I think at that stage, the investor shouldn't be, you shouldn't be worried about those types of things yet. I think that, and all of that will become important later. So not to say it's not important, but just in its like its kind of simplest form, it's a whole wide range. Like you said, some founders will have a few points of a company, percentage points, and then some might have 75% of the company, and so each investor will look at that differently. But hopefully at a minimum, if it feels like it's low and you feel like that's a concern or something like that, I feel like then the investor should, they should be asking a question about making sure that everybody's kind of settled appropriately and in it for a long time period, like 5+ years,
Yeah. And that's a great point. The question behind the question is the founder truly committed to the company, and are they going to take it through to the long haul? And so that is one of those things. I think we talked earlier about, if you have kind of a weakness or a perceived weakness, get out in front of it, address it. And so I think that's a great one where the founder can say, I don't have that much equity, but here's why I'm very excited and committed to this.
Yeah. One question there too, I think it's kind of an interesting one that there's a question underlying all that too, which is, how big of a company are you building? And an investor might say, well, because I'm, there's definitely companies that build to only a modest amount of ARR and sell for, $10 or $20 million, and the founder actually owns a big piece of it. In that reality, the founder is very motivated to potentially sell early and not build, a larger company. When you have a founder that's got the right dynamics, and you got venture, if you have an investor that wants to build $1 billion outcomes, single digit ownership may be the right incentive for everyone, because you have to make room for really strategic investors and things like that. And so that's one thing, just as a parting thought on that subject is, I think there's just a good balance of kind of getting everybody, getting rewards of investors and founders, and kind of everybody along the way, having a good outcome versus just the founder and one investor or something like that. So it just depends. That is how big of a company are you building is probably the question you want to ask yourself too.
Great. We're at 2:05 Eastern. We're 5 after the webinar, so I certainly understand if people have to hop off. I will personally follow up with everyone whose questions we didn't get to. I'll send you an email and answer those questions the best I can. I may consult with Eric on those if one makes sense for him. But I want to thank everybody for their participation and for attending today. We are going to send out the recording next week with the deck, the resources we talked about, all that good stuff. You can learn more about Visible at visible.vc. You can learn more about Zylo at zylo.com, Zylo. So yeah, thanks to everyone. Eric, I don't know if you have any parting thoughts or parting pieces of advice that you want to share.
Invest in relationships now and use your referral network and think about it now, well before your round, I think. And if you haven't already, it's still not too late to start. So I think that was a long game. So
that's great. Had a suggestion for a similar session on a seed raise. I think that would be great. So maybe look for that in the future. Thank you, everybody, for attending. Thanks a lot, Eric. And we'll go ahead and sign off. Thanks, everyone. Have a great.
Thanks.